You are listening to Revealing Real Estate Podcast, where we dive into getting over your fear of taking risk in real estate and making money while you sleep. I'm Nico Pedizano, your host and real estate guru with over 20 years of experience. It's time to get real. We have a wonderful guest on the show, so we figure we're going to try something where we're going to try to kill two birds with one stone. We're actually going to go live on Instagram, Tom. And I have Tom Villano here from Owl Mortgages. We're going to talk about the current state of the interest rates. We have a big announcement that's going to be taking place tomorrow. And we're going to be talking about consumer debt report that just came out for 2023, which is going to be something that is on a lot of Canadians' minds and how they're dealing with the financial strain that's currently happening that we've talked about many times with Vince Gaetano on the show. So I'm hoping that everybody can hear us pretty clear from a distance because we have the camera on the live right now. And we're also doing a live podcast at the same time just to kind of get everybody up to speed. And we wanted to get Tom to do it. And since I had Tom in the office, I said, hey, Tom, let's do a live podcast. Plus, let's go live on Instagram together. And what we're going to be talking about today is what's happening with the Bank of Canada's announcement tomorrow. And are interest rates going to start climbing upwards, or are they going to stay stable for the next quarter? Tom, what's your opinion on that? And can you give our viewers a little bit of understanding of what's going to happen with that?
Sure, for sure. Thanks for having me on again, Nick. Always a pleasure to do these
always
these podcasts.
As nerve-wracking as they are, right?
Lives with you. Yeah, no. I mean, I take great pleasure in talking about this stuff. But yeah, so big day tomorrow. We have Bank of Canada makes another rate announcement 10 a.m. tomorrow morning. Just through reading and trying to keep up to date on everything rate and mortgage related. There's a big consensus that the bank may stand firm for one more month. The April numbers were that inflation had increased slightly and not enough to really have a knee-jerk reaction to raise rates right away, but there was a slight increase. Again, I don't think it's enough to warrant another quarter point or half point increase. And I think the consensus among a lot of economists is that it's going to stay flat for one more month. And depending on what happens between, now and the next, when they make the next announcement in terms of inflation, we may see an increase in July. The street is that rates are going to stay firm, the overnight rate tomorrow. But we are starting to see an increase in fixed rates go up. So I'd say for the last 4 to 6 weeks, rates have been pretty aggressive. A lot of the banks have been dropping their midterm, 2, 3, and 4 year rates. Lots of renewals coming up in the market, and people have been capitalizing on taking some fairly aggressive fixed term rates, but shorter term, so the 2, 3, and 4 year term. But we've seen a turnaround in that in the last 5 to 7 days, where even short term fixed rates have been starting to increase, and we've seen those increase anywhere between 15 and 40 basis points across some of our different lenders.
And is that the banks taking it from their own perspective to say, hey, at the end of the day, they did it where they're going to start raising the rates for themselves, knowing that the Bank of Canada is keeping rates pretty stable right now? They decided to kind of start raising rates on their own?
Well, basically, the fixed rates are closely tied to bond rates. So when there's an increase in the bond rates, whether they're short-term or long-term bonds, that's when they're reflected in fixed rate mortgages. So there's been an increase in the shorter term bond rates, bond yields. So that gets reflected in the mortgage rates. Now, most banks normally raise a lot easier than they do to reduce the rate. So, for example, if we see bond rates start to drop a little bit, chances are they're not going to start dropping the short term or even the fixed rates right away. They'll usually wait a while before they start dropping those. They want to see a trend and see that it's been there's a continuous sort of flat spot where they're not increasing even a minimal increase to lower that rate.
Yeah, I personally think that the rates will have to stay the same for at least another quarter for sure. I don't see the real estate market in general is really kicking off really well, despite the fact of what a lot of the media was saying and was always doom and gloom, and the recession was here and everything was just kind of everybody was worried, sitting on the sidelines waiting to see what was going to happen with the real estate market in whole. As you know, we've seen incremental jumps when it comes to rates in the housing market. And things are moving really good, especially at the lower price point, anything under 1.5 or lower in that evaluation. We're still seeing a lot of multiple offers happening. Homes are still selling in a week. When you get to $3 million, that $3 million was the old $4 million pre-COVID. But there's reports coming out from the 2023 Consumer Debt Report, and there's a lot of talk about it that you're hearing about how Canadians have absorbed so much of now more debt because the cost of goods and how much they've increased. If you look at the household debt ratio in comparison to any other country in the G7, Canada actually sits as one of the most, having the most household debt in the G7 itself. Which makes things very vulnerable from a global perspective, right? It could make almost sometimes for an economic crisis. So when you have now interest rates that actually do increase, you can create further major complications in the market itself that are going to create bigger problems, right? Would you agree to that?
I agree 100%. I mean, the for lack of a better term, the banks are partly at fault for that. In Canada, it's easy compared to some of the other G7 nations to access equity. So, for example, we see it firsthand in Southern Ontario here, where people will refinance their home, and whether it's to fund a vacation, fund a vacation home, or fund some type of some other activity. It's easy to gain access to the equity in your home in order to do that, right?
Right.
Mind you, it's not always the best best advice to give to people, but because it's become sort of ingrained in the way people when they first take out a mortgage, they start with a simple mortgage, and then the banks, a lot of times the bank will offer them a line of credit, similar to a HELOC, right?
Right.
And this sort of aids in their spending. I've noticed though in the past year with the rise of interest rates and inflation, people are relying on that sort of as a cash flow for them as well. So instead of really using it for the vacation properties, or to go on vacation, or purchase a new car, or help send their kids to school, they're using it more for day-to-day living because the cost of bread has gone up, the cost of a basket of goods has gone up. They've had to rely on that equity in order to live, basically, right? Yeah. And usually the rates in an equity line are much less than, for example, on a credit card. So I think people are more likely to start using the equity out of their home as opposed to a credit card.
Yeah, and we're finding that happen, but credit card debt is really high up there based on the consumer report that just came out. We're talking that you've seen consumer debt top $2.36 trillion right now in Canada, and it's up by 7.3% from last year. And those are some staggering numbers, because what it's saying to me, and what it's actually, from my interpretation of what I'm reading, the amount Canadians are resilient. Mm-hmm. So I feel that Canadians will go out there and find ways to continue to pay down their mortgages, or make sure that their mortgage is paid first, right? People buy mortgages, right?
Defaults are very low. I mean, we're not seeing a lot of power sales. I don't know if you have access to Treb. You probably see that a lot.
I don't see a lot of them. No, yeah, I don't. I don't.
So people find a way to make their payments, whether it's borrowing from family, dipping into their savings. We had the debt report come out from Equifax today. Yep. I'm sure there's going to be a report soon to talk about people that are relying on, maybe putting money, when they put money away for a rainy day. Now they're actually having to use it, whether it's in an RSP or even their TFSAs. now they're having to dip into it in order to sort of keep up with paying their bills and just day-to-day living costs.
Yeah, and that's my worry where I think, when it comes to the feds and raising the rates and the Bank of Canada, they have to really err on the side of caution right now. And that's why I think that the rates will maintain to stay like this for the remainder of the year. I don't see any real further increases really starting to happen myself. This is just an opinion. I'm not a professional within that field. My job is to sell real estate. And if you want to know what the value of your home is, give me a call. But I will rely on guys like yourself and Vince Gaetano that are part of the team to help surround me and all that stuff. I just feel that if you start making these now incremental bumps, it's just going to now it's going to tip people over the edge. And then you really start seeing the foreclosures and the power sales or the really distressed sales that are going to start to happen, right?
I agree. I mean, we're on the front lines, Nick, like yourself. We meet with the clients, we talking to them on a daily basis. We see what a quarter point increase in a rate does to people's spending habits,
and then how about employment too, right? Unemployment is starting to rise. Apparently, it's at 6.8%.
It's still strong. Right. Our employment numbers are still strong,
right?
Which is another contributing factor with inflation, right? So more people working just means that they're still driving the prices higher than they should be. But again, it's very delicate. I agree with you. Being on the front line, we see this on a daily basis. We're the ones answering the calls when clients are saying, well, what should I do? I have a mortgage coming up for renewal. I've always been variable. Should I stay variable? Should I go fixed? You got to take that time to sort of sit down and go through what their lives are going to look like, whether it's a fixed or a variable mortgage.
Right.
What to expect. If you were to lock into a fixed rate and, for lack of a better term, being married to that rate for the next, 2, 3 or 4 or 5 years, and how it's going to affect their lifestyle should rates come down and they want to, saying, I should have waited, right? But again, there's lots of options out there. Going 5-year fixed or going 3-year fixed is not the answer for everybody. And it's, looking at everyone's on a case-by-case basis and making that recommendation, especially on a renewal right now. A lot of people can't move their mortgage to another bank. Years ago when it was easier to qualify, it's easy to move a mortgage around from one institution to another. But now with the qualifying rate being where they are, it's made it a little more difficult. So a lot of people are just renewing with their existing bank. They may not have the best options with them, but it might be the path of least resistance for the time being in order to wait for rates to come down and the qualifying rate to change as well.
So I want to talk about kind of the state of Canadians' personal financing, and I was looking at the consumer index report, and there was something that really stood out to me, and I'm just going to repeat it kind of word per word on it. And it says here, amidst inflation, the rate hikes in 2022, Canadians are more likely to feel worse off now than better. While levels of confidence and anxiety about personal financing are similar to 1 year from 1 year ago, the specific circumstances of Canadians have notably changed. Canadians struggled more in 2022 because of cost, whereas in 2021 or 2020, it had more to do with economic uncertainty. While job instability has been much less of an issue over the past 12 months, spending more on essentials has become an even bigger reason for Canadians' worsening financial situation, with more than half ranking it is as the number one contributing factor. Also notable is a significant increase in spending on non-essentials over the past year. Mm-hmm. So spending on these essential goods, despite the rise of inflation itself, just the cost of living through lifestyle is becoming very expensive, and people are using a lot of their MasterCards right now just to hold them off. You can get a lot of cash back from these MasterCards. That's too. Right. What they'll do is they'll take cash back and sometimes use that as leverage, and then just continue paying those interest rates every single month, riding it out, hopefully that this interest rate is going to change or the economy will change to kind of start decreasing in the cost of these goods. I just don't think that's happening. If I look at the commercial sector and the industrial space, the rent that they're currently charging, that landlords are currently charging today, at $20 a square foot for a building that's 50, 60, 100,000 square feet, the warehousing to store that product is expensive for the manufacturer. And when he has to now redistribute that price, he's going to put the cost of now the rates for wholesaling all the goods inside or warehousing into the product. And all of a sudden you get these goods that go up, and these guys sign terms of 5-year, 10-year leases. So I don't see these goods really coming down anytime soon, despite the fact of inflation coming down as well within the price points itself. It's just that the cost of rentable space in the real estate market has become so expensive on it. So I just want, do you, when you, and you deal with a lot of consumers today, you have those conversations. Do you see the struggles? Are you feeling the struggles with them right now?
Enjoying this episode? Subscribe to our channel and leave us a comment down below to let us know what you want to learn next. Make sure you're following our Instagram and TikTok to stay up to date on our new episodes every Friday.
Again, yeah, I mean, I think in the past, people were really focused on rate, and there was always a sort of what's the best rate I can get on any type of mortgage term, and they were really always focused on rate. Now I think more often than not, they're looking at their payments and working backwards from there and saying, okay, what can I afford on a monthly basis, and what's my best option in terms of a rate in order to get that to that price point. So you're almost working backwards and having to break down the transaction that way there. Say, okay, this is your budget. This is what you budgeted for a mortgage. Right. Maybe the 5 year is not the term for you. Maybe the 1 year or the 2 year or the variable is the term for you for the time being until the rates were to come down or until inflation or the cost of goods were to come down as well. We're seeing a lot. Again, we're seeing a trend against going with that regular 5 year fixed rate. A lot of times, when people are asking me for cash flow purposes, right? If they have a HELOC or something, a mortgage that's got a line of credit attached to it, I'm advising people or suggesting maybe you just leave it floating on a line of credit for the time being, right? And gives you a little more flexibility because it's an interest-only payment. Right. Yeah. But it also it allows you to sort of act quickly and efficiently if the rates were to come down. You can always take a portion of your line of credit and lock it into, let's say the 5 year rates come down to a level where you're more comfortable locking it in. We can always lock in a portion of it, or we can lock in the entire amount into that 5 year fixed mortgage or the variable or the 1 year, 2 year, whatever sort of is going to help you on a month-to-month basis in terms of budgeting and making payments. So that's an option for a lot of renewals coming up over the next I'd say 6 to 12 months.
Yeah,
until we see rates start to come down.
Yeah, there's a big number of renewals that are going to be coming out this year for 2023. So I'd be curious to see kind of what positions people would either want to move forward with. Either you go with the variable or do you go with the fixed at this point in time. If one of our viewers are listening right now and they're in that position and they need to renew their mortgage, what would you advise at this point in time? Would you consider still running with a short-term fixed?
Again, I always suggest the lowest rate possible, whether it's a 1 year, 2 year, 3 year, 4 year, 5 year. Take the lowest rate.
So hold on a second. So what's the variable rate right now?
Again, it varies across different institutions, right? We have some that are prime plus, let's say 5 basis points, or then some of them are prime minus 30 or 40.
Just for viewers not listening.
6.7% is the posted variable rate, and then
6.7%.
Yeah,
wow.
Exactly. And different banks sort of negotiate from there, whether it's plus basis points or minus basis points. But 6.7, it's high. I mean, it's the highest level I've ever seen since I've been in the industry.
It's high, but it's still cheap money.
Correct.
Right.
Correct.
When in comparison to what the norm
We're
is
used to paying.
And what they
Exactly,
used to pay, 2% to 3%.
Exactly.
You won't see those days for a very long time.
Probably until the end of 2024 and into 2025, we'll start to see a little more aggressive.
But what can that be? Rates. That'll drop down to 4, right? Exactly. 3.5, 4.
Well, they're calling for the Bank of Canada to be at 3.5% by the end of 2024. the overnight rate. So the variable rate.
The variable rate, correct.
Yeah. So that's, you're still looking at mid fives as the posted
And I
bank
think that's what
variable
Canadians
rate.
are going to get accustomed to paying these new type of rates within the market. I talk to my dad all the time. He goes, he always jokes around. Yeah, you guys don't know what interest rates are. When we had our mortgages, they were paying 18% back in the days. I know that things have changed, but from his perspective, he still looks at it as a very cheap number, because if you're used to back
Compared
in the
to
day, back then,
correct.
paying those kind of interest rates, you're still paying very cheap. So then on the fixed side of things, what's the rate running on the fixed side?
So again, you're looking, best 3-4 year rates. You're looking at in and around the 5% mark, 5 or just over 5%. 5-year fixed insurable, mid 4.5s, 4%, like 4.54, 4.59%. But that's insurable. So less than 20% down, less than $1 million purchase price. Those are still very aggressive. It's more when you get to the conventional, where it's not as aggressive as the high ratio rates currently.
What's the current average mortgage that a Canadian is taking on today, Tom? Would you happen to know what kind of that approximate number?
Yeah,
across
Canada be difficult. I know for example, Southern Ontario. If I just look back at my numbers, I'd probably say my average mortgage, average, is close to $1 million.
It's close to $1 million.
Yeah.
Yeah, I remember I bought my first house back in 2004, and I ended up paying, I think, close to $400,000 for it, right? And then I think I took on a $300,000 mortgage. I'm like, wow, that's high. That was expensive,
Yeah, it was,
right? And I'm like,
exactly.
now you compare it to what the average Canadian is taking out, or Ontarian is taking out. It's pretty.
The numbers increased quite a bit.
Numbers increased quite a bit, and when you're paying those high interest rates today, it could get worrisome. And that's why a lot of my recommendations are today, especially, who I feel sorry for the most right now, are the ones that are affecting young Canadians. They're the ones that I think are feeling the biggest pinch here, due to the cost of interest rates rising and the cost of the housing market that is fully increased today. It is like I got young staff, millennials, that I kind of really talk to all the time and preach, young family members and friends. And my advice to them is always really try to get into the market as soon as you can. Because if we look at real estate in a home in 5 years, 10 years, 20 years from now, it ain't going to get any cheaper.
No. And it comes back. I mean, if you look in history, we have, there's moments where there's a big push in the real estate, but it always comes back to previous highs, right?
Yeah.
And it's just, real estate is cyclical, just like any other type of economy. With prices increases and with interest rate increases, we've seen over the past year where rentals has gone up in price, right? And to your point regarding, this younger generation trying to get into the market, how are they going to save money for a down payment if they're overpaying on rent on a monthly basis, right? For example, at one time they were probably paying $2,000 a month on a condo downtown Toronto for rent. Now they're $2,600. I've heard numbers, where they're paying 30-40% more than what it was 2-3 years ago, right?
Well, basement apartments in Vaughan right now are hitting $2,100 a month, and that's for a basement apartment, and that's for a detached household, maybe about 2,500 to 3,000 square feet. Rental basements are generating $2,000 a month. So, like you said, the average mortgage is $1 million.
And to that point, a lot of people that are buying the single detached homes or even semis, they're converting their basements into apartments because they need that assistance.
House hacking is a great strategy
right?
today, and there's nothing to be ashamed about, right? And I think it's essential, especially for young, inspiring people that want to have that dream of owning a home one day. And, I believe home ownership should start as early as possible. There are ways to get creative, finding even partners that can help you through the process to help build your wealth through that process on it. And those that have earned it, I don't see the real estate market in the next little while dipping down at price points unless we get these really big bank hikes. And I don't think that's going to happen.
No.
I think you're going to create more pandemonium. You're going to create so much havoc within the real estate market. And
well, even with these increased rates, Nick, I read, I see posts, I read all the time that there's lack of supply, right?
Which
there's
there
not
is.
there, for lack of a better term, it's a seller's market because there are so few listings out there. And people are competing for a handful of homes in any particular neighborhood, and it doesn't, and it's driving up the prices again, and it's not stopping people from buying. Homes. I don't know how long do you see homes sitting on the market in let's take Vaughan for example, or Toronto.
Yeah, under $1.5 million, they're gone pretty quick.
Yeah.
Right. And then once you hit 1.5 to 2.5, they're still only lasting 15 days, which is the average days on market. But I'm going to be waiting for the next index report from the Toronto MLS system. They're going to be coming out with their market watch report. I think it comes out every 6th of the month. What day is it today? So that came out today.
So today, yeah.
Yeah, so I'd like to see that report. And I guarantee you we'll probably see another further increase in values. I think from January till now, from last month, it increased by about 17%. I won't be surprised if you see another 3% hike in the market right now to on values.
Yeah.
And I think we are probably back to now, I would say easily last year's pricing again, right? At this time of year, right?
And I think even given that we've had these high interest rates for the past, I want to say 9 to 12 months, it's ingrained in people now when they're putting offers on homes or they're looking at homes. They already know the expectation is that they're going to be paying a higher interest rate, right? And it's definitely a vote of confidence in the real estate market if people are still willing to put willing to have multiple offers on a property, knowing that when they have to close that, they're going to be at a higher interest rate as opposed to they were 2 years ago when we're going through the pandemic, right? So people are prepared to pay that higher monthly mortgage cost, getting into these transactions.
I feel that there's a third of Canadians right now that are very anxious about their current financial situation. The lower income earners, those who experience employment change due to COVID, and those carrying higher non-mortgage debt are amongst those feeling the most anxious right now. And I feel that anxiousness, you can see it in the market. When I'm dealing with the public, when I'm dealing with clients every single day, there is still that uncertainty. There is that anxiousness where people do want to get into the market, but they don't because they don't want to carry on all that stress, and it weighs out on them.
Makes sense for sure. Yeah. Again, it's it's an added pressure to make a monthly mortgage payment. If they're just making rent payments right now, it's easier to sort of move from one rental to another than it is to get into a house and then realize 6 months down the road that maybe you've bitten off too much that you can chew and wanting to go through the process of selling it and then moving out again. So it is definitely more feasible if you're not ready to make the long-term home ownership commitment to stay in the rental market. But again, I know we've had this discussion in the past. I'm a strong supporter of buying pre-construction, whether it's a condo or even just to get into the market, right?
I get it, and that's good.
Nice because it gives you a 2 or 3 year window while the project is sort of getting out of the ground and being constructed, for you to save a little bit more money and get into a project where it's a price point where to make a 20% down payment today is much easier to spread that across 2 or 3 years and then move into it 2 or 3 years down the road. It's always a great first step into home ownership.
The Consumer Index report, which I have in front of me right now, actually stipulates that 1 in 10 Canadians with non-mortgage debt are deferring their debt payments, which I think is a huge problem, right? And what people have to understand is that if you keep deferring those payments, and you keep paying those high interest rates, especially on your MasterCards and your Visas at 18%, it's just going to kind of bring you down and continue to bring you down that dark hole. Because once you start paying interest, then you can continue making these MasterCard companies the money, and the banks further. That's where they make their big money. They are operating as a full business. And what we're seeing is that majority of people, just to survive right now, just every month keep deferring that payment, keep deferring that debt. And I think that's becoming a real bigger problem in regards to interest rates right now, right?
Yeah, and I think a lot of the banks and a lot of these financial providers like the Visas and the MasterCards, American, they made it very easy during COVID, just to dial up a number and say, hey, can I defer X amount of payments over the next couple of months? I'm having difficulty making payments. Right. So it was easy for them to sort of take on that conversation and have clients call in. I think sometimes people might be abusing it. Yes. But again, everyone's situation is different, right? Things that you can't budget for when they come up, maybe you do need that extra leeway in terms of making that monthly mortgage, that monthly payment to whether it's a Visa or a MasterCard. It's tough. I mean, we're going through some, I don't want to say difficult times, but it's with the cost of living where it is, it's tough for a lot of Canadians for sure.
They say here how Canadians are managing their debt, and it says 33% of Canadians are paying much more than the minimum payment. So that's 33% of Canadians. Another 33%. The other 33% are paying a bit more than their minimum payments.
Okay.
24% are paying minimum required payments only. 6% are unable to keep up with a minimum payment, but are not deferring, and another 5% are deferring their debt payments itself. So if you look at the big scheme of things, population-wise, it's not all that bad.
No,
it's still pretty good. I like the part where you got a big chunk of it that are paying much more than their minimum payment right now, because you want to try to bring down that debt as much as possible.
Consumer
because
debt for sure.
If we can get young, inspiring millennials to want to really start investing in, and that's what I'm speaking to, the young people that are looking to want to get into home ownership, you need to start saving now. Mm-hmm. And that's the message here. And that's what this message is about. And that's what this podcast is about today, is making people aware that having all that debt and paying all those high interest will just further set you back. So try to burn as much as you can down, make more than that minimum payment if you can, get yourself out of that, continue to save money. There's what's called a first-time home. The government just announced this as well. It's like a TFSA or RSP. It's a first-time home buyers savings account.
Savings account, correct?
And basically you're able to contribute, I believe, up to $8,000 a year, which is not much. It's not a lot of money. It takes you 10 years to save up $80,000. But if you made or earned money using that money and you pulled it out to purchase a home, that would be tax-free.
Correct.
Right?
Correct.
So that is something that young Canadians, I can look at the camera and say this here. It is an option for you. Or maybe I should look at this camera. I don't know which one's looking at me better. But it is an option for you. If you're a first-time home buyer and you're looking to save right now, the best option for you today is open up a first-time home buyer's account. This will allow you to put inside up to $8,000 of tax-free savings money. And if you made money and earned money in that account, whether through a stock, within the stock market itself, and you've earned some money on that money that you earned, if you bought a home using that money within that account, it is tax-free. Now, speak to your accountant. I'm going to have the accountants on the show, I think, next week. It's a good question. We can ask them how to really kind of take the full benefits of that. But that is an option, and that is something.
Yeah, so similar to a TFSA where you can use it towards your first time home purchase. I mean, and you also have the RSP tool as well, right? Where you can draw from your RSP as a first time home buyer.
Listen, Tom, this was great having you on the show. I appreciate you coming out.
Always a pleasure. Thanks for having me.
You've made a great effort in sharing your knowledge and helping Canadians out there to if anybody's in need of getting some financing or getting creative to look for some finance options, I think you are a good go-to guy.
Thank you.
And glad to have you part of the team. But thanks for coming on the show today.
Thank you very much.
No problem.
Thanks, everyone.
Thanks.
Looking to buy or sell? Call a team you can trust. Don't believe me? Our Google reviews say it all. Put us on your lawn, your house will be gone. TheOPteam.com.